introduction, as just a quick introduction about where we are in the market today. Screen should go across. There we go. So there was huge speculation today around the Bank of England increasing the Bank of England base rate. The chief in the hot seat decided not to, alongside his members. They voted 7-2 against increasing the Bank of England base rate after much speculation. Who knows when they're going to increase the base rate, but I think what is certain, we are certainly going to see an increase in the bank base rate from 0.1 very, very soon. I actually predicted that we were going to have an increase in December, which is next month, but I think they're going to push it backwards to February, to be honest. But what is quite certain is we are going to see increases in the Bank of England base rate. So for those that are on standard variable rates, as soon as the Bank of England does increase their rates, those rates are going to be going up. So be conscious of your mortgage deals that are on the standard variable rates, or if you've got deals ending in 2022, now's probably a good time to speak to the brokers like ourselves, who can give you cost comparisons and see where we can save you some money. Nationwide this week put an announcement out around house price predictions. You know, we'd love to hear more what you think. Is it an up or is it a down? Where do you think house prices are going to be in 2022? Over the last 18 months, we've seen house prices increase phenomenally, depending on what side you're on the boat, but we've seen prices substantially grow. Nationwide have said year on year, just shy of 10% highest house price inflation. Average property prices have had 30,000 during the pandemic. And as I said, there's huge rumors of a base rate increase, which is inevitable. Last week, we talked about rates, and I'm going to come back to that very, very soon. But I thought I'll just talk about top 10 house buying tips, making your new home easy. First and foremost, before you go shopping, i.e. look at properties, please do consult with a mortgage brokerage, because you need to understand your affordability, understand the timescales of the mortgage process, and work with us as your mortgage brokers. The last thing you want to do is expect that you can borrow X amount, but you can only borrow Y amount. So first things first, ensure you know exactly how much you can borrow before you start engaging with the estate agents and start doing viewings. Second of all is understand the cost of buying a property. So you've got SDLT, which is stamp duty land tax. Now, it can be quite painful to pay such a large bill, but you know, everyone has to pay it, whether you're buying your first home, second home, or investment property. So be conscious of stamp duty land tax. Legal fees, there's conveyancer bills to pay. There is usually survey fees to pay, and also removal costs. So they're just a small amount of extra fees that you need to make sure you have in your back pocket to cover the additional cost, let alone the deposit for the new home purchase. Getting a mortgage, agreement in principle, and that's where we play a pivotal part. A lot of estate agents won't open the doors for you until they see a decision in principle in place, and that's going back to point one. There is understanding your affordability, and what we'll do here as experienced brokers is go through your income and affordability, understand what the goals are, and then present you with an agreement in principle with potential rates of interest that mortgage providers will expect you to pay. Check out the neighborhood that you want to buy in. You know, there's lots of up and coming neighborhoods. Understand where you want to buy, why you want to buy. Is it schools? Is it local environment? Is it shops? Is it hospitality? Is it close to work? Understand what's key for you, and certainly work with agents, informing them of the types of properties that you want to buy. Research how much you want to offer for the property. You know, agents want the highest price because they're selling the property on behalf of their clients. Do your cost comparisons. My view is, if a property's on the market for 300,000, you know, a cheeky bid is not 200. That's the right bid. You know, it's very easy to work downwards, but go upwards. You know, go in under, because you don't know what the other side are expecting, and you don't know what their expectations are. So having yourself as a well-presented potential buyer is key. Having your agreement principle, having a proof of deposit. Estate agents do like that, but don't just go in for the asking price. Tell them why. Do your research, I should say, and then go in with a price. Ask the seller to take it off the market. So once you've put in an offer and it's been accepted, ensure the estate agents take it off the market, and that ensures that nobody then comes in and puts in a cheeky offer higher than yours, and then they capture the deal. So make sure the agent takes it off the market once your offer is accepted. Going back to the other points I talked about earlier, make sure you use professionals. There's a very good saying about, if you think it's expensive using a professional, wait till you use somebody that's not experienced. So, sometimes you've got to pay to get the best service and the most experience, and it does pay for long term. Communication's key in our business. In most businesses, you've got to keep an open dialogue. So in our business, that's the mortgage broker, that's the legal conveyancer, that's the estate agent. They are key in ensuring that you get the property in a timely manner. So making sure that you've got open dialogue, and that's for all parties involved. And we must keep that open two-way dialogue with all parties. Book your removal company. At the moment, during COVID, there was no removal companies available. Everyone was fully booked. So, preempt these sort of things, plan ahead and work to those deadlines. And the last one I've put there is a cheeky one. Obviously a new home, you want to celebrate. So maybe book yourself a delivery dinner to celebrate the first night with a bottle of champagne. The next slide is the EPC rating. So for those that don't know, if you've got an investment property, you would be applicable for a buy-to-let mortgage as long as your EPC, which stands for Energy Performance Certificate, has a rating between E and A. Please do bear in mind, from 2025, all new tenancies will have to be a C to an A. So anything below C will not be applicable for a buy-to-let mortgage. And for existing tenancies, that then comes into play from 2028. So for those buy-to-let properties that you've got in your portfolio, keep an eye on your energy performance ratings. If they are a D or E, it's now, I'd encourage you to start looking at ways to improving the performance of your property, because from 2025 and 2028, you're going to have them at C level, at C grade or higher. So bear that in mind. Dil always asks me to put the rates on the slides. It's nice to see, brings a bit more life to mortgages. What I want to say about rates is, it's not necessarily the cheapest rate fits all, but it's key that as mortgage brokers, and as I said, we're independent and hold the market, we'll always try to get our clients the most competitive rates based on property, loan to value, income, portfolio size, and many other variables. So giving you an example there, the rates for a HMO buy-to-let in a limited company structure start from 2.88 for a 5-year fix, that's 75% loan to value. If you are purchasing a buy-to-let in your personal name, rates start from 1.14 for a 5-year fix, that's 75% loan to value. What I would say is, with rates, lenders are always changing the goalpost weekly, if not daily at the moment. Everyone was conscious of a rate increase with the Bank of England. That didn't happen, but there were a few lenders out there in the market this week have increased their rates by 5 or 10 basis points because they were conscious of rate changes. So be mindful. As I said, review your portfolio. Any buy-to-lets that you've got or home mortgages that are coming up for renewal from 2022, now's a good time to start talking to brokers like ourselves to give you more of an understanding of where the rates lie and what you'd be applicable for. If you're looking to buy your first new home or looking to move, rates start at 1.69 for a 90% loan to value 2-year fixed. It's still very, very phenomenally low. Likewise, if you've got 40% equity, rates start from 0.89, which is phenomenal, under a 1% if you're borrowing at 60% loan to value. So we've got some really, really great key rates in the market. It's all about understanding your goals, your priorities, and working alongside you. So as a promise to you, and what we do to all our clients, is ensuring that we find the most suitable mortgage for you and then deliver on your on your requirements where possible. We're all over social media, so you can catch us on YouTube, Twitter, Instagram, LinkedIn, and Facebook. Most of our URL handles are at our mortgage broker. So feel free to contact us via social media channels and or via our website as well. We'll happily answer any questions that you have. As Dil mentioned at the beginning, we have an office here in Bracknell in Berkshire, but we've got advisors in and around Greater London and in London particularly. And we'd love to hear from you. Thank you, Dil.
Thank you, Akhil. Very informative. Where do you think house prices are going to go?
I'm quite an historic guy, and what I mean by that is it's always been going up one way. You're always going to have peaks and troughs in any market, and property's no substitute. So I certainly think prices will always go in the upward manner, and the reason why I say that is because we've always had an issue with a lack of housing. So I think housing, supply and demand. So I think for that reason, we're always going to see prices going up. Where the issues lie, and the reason why I think they didn't increase the Bank of England base rate was simply because furlough just ended in September. They've got to see how it plays out for the next couple of months around unemployment and whether they should then increase base rate or not. Inflation is jacked up at the moment, circa 5%. Is it going to come down? Is it a bubble? Who knows? But I certainly think house prices will go up. Whether they go up another 10% over the next 12 months, I don't know. But I certainly can't see them coming down 10%, that's for sure.
Okay, and one last question for you. When are you getting your seat on the Bank of England board?
No, I prefer my seat here in Bracknell, so I'd rather just watch it from this side of the fence.
All right. No, as always, and you talked about professionals, and we certainly have our share of really good professionals on this show. So thank you for that. You say you're not getting your seat on the Bank of England. I think you should do.
Thank you, Dil.
You've been in the industry long enough. You know your stuff, so definitely you should get your seat. Right, and tentatively linking on to another guest who should have another seat on the Bank of England board is Bhupinder Anand. He was here a little while ago, and he gave us some really interesting information and presentation and stuff to think about. So look, we've broken out the piggy bank. We've got all our 50p's ready. We're going to be able to put them in the meter. So Bhupinder, we've almost spared no expense. So just a quick intro to Bhupinder. Bhupinder sits in the middle of solicitors, accountants, and financial advisors. So he's the guy that understands it in all three directions. And he doesn't like any of the three, apart from 𝗟𝗑𝐿, but he doesn't know 𝗟𝗑𝐿 properly yet. So 𝗟𝗑𝐿, he likes you. That's what I'm told. He doesn't like the other three. And with that said, enough said. He's a chap really worth listening to. So please put down your colouring pencils, get out your note-taking pens, and take some great notes, because Bhupinder's going to give you some really good information. Bhupinder, I'm going to try and put enough 50p's in the meter so you can get through all your presentation. Enough of me talking. Over to you, sir.
Thank you, Dil. I appreciate the introduction. I'm just going to go and do a screen share so I can get organised. Can you tell me if you can see that?
When life insurance goes wrong.
Yeah, that's going to be the subject of my presentation. There we go. It's working now. Right, can you see that?
Yeah. Oh, flipping hell, you've got a proper animation going on there. Yeah.
Okay.
No expense spared on your slides. Yeah.
Well, yeah, you need extra 50p's for this because
listen,
the bandwidth is being used for sure.
I might run out, so let's fingers crossed. Then over to you, sir.
Okay, so this is a provocative title to a speech of when life assurance goes wrong, because there's so many things that can go wrong. And one of the reasons I came up with this subject was because I've seen across my 30-year career horrendous things go wrong, either because of poor decisions made by individuals or poor advice received by individuals. So what I want to do in this presentation is go through things you should know. Now, that doesn't mean you should understand, because there's a lot to understand. And I've been doing this for 30 years and still trying to understand stuff. But there's things that you should know so that you make informed decisions. So I'm going to spend quite a bit of time going through lots of jargon. And it obviously in a session like this, we can't go too deep. But I just want to show you how broad the subject is so that you know to take proper advice and don't try and do this stuff yourself. Okay, quick bit of introduction to myself. I'm an IFA, an independent financial advisor. It means I'm not tied in with any company at all. And I've been an IFA for nearly 30 years. And I'm proud to say across that time, I've twice won the award for UK IFA of the Year, which is #1 out of 30,000. Dil, if you had enough 50p's in the meter, you'd hear the trumpets in the background as well. And in addition to that, Evening Standard has also rated me as best IFA in the capital. So I'm very honored about that. And I'm in fact, this slide's old now. So I'm a 25-year member of something called the $1 Million Roundtable. That's an American association that represents the world's best 85,000 financial advisors from around the world. And I'm really honored to be one of those for the last 25 years. As a result of that, I'm also a global speaker. So I speak at major financial services conferences all around the world. My largest audience was 12,000 people in Vancouver, for example, on the subject of life insurance. So I feel I know something about what I'm going to be talking about. I'm also an author. I've written a book, a motivational book, and a coach to other financial advisors. At the moment, for example, I'm coaching 50 financial advisors in Dubai. I go there every 3 months, post-lockdown, and spend a day with them and teach them new ideas on how they can better advise their clients. Anyway, that's a bit of an intro to me. Let's really get into the meat of the subject. Dill said that a few months ago, I did a session with the group, and that was on the subject of estate planning, creative estate planning. Why should I be the person to give that subject? You see, most people would think if you're going to talk about estate planning, by the way, I don't always talk this fast. I'm just doing it because there's a lot to cover. So forgive me for putting it through some speed. But people think you need to go and talk to a lawyer if you need a will or you need a trust. The reality is, however, lawyers and wills don't talk about tax. And therefore, you end up with somebody who takes your instructions rather than gives you advice. So you might then say, I'll go and talk to an accountant because it's about inheritance tax advice. And the reality is, and I can say this because I've been doing this for 30 years, so I know, is that most accountants know what inheritance tax is, but they don't know how to deal with it, and they know nothing about law or financial planning. So you might go and see a financial advisor. And I can say what I'm about to say now because I train financial advisors. So I'm allowed to say this. Most financial advisors, when it comes to inheritance tax planning, can't even spell law or tax. They're too busy trying to sell you something. That's where I've set up, alongside Anand Financial Architecture as the financial services business, a second business called Anand Wills and Trusts, which means I occupy a unique space, as Dill said, where under one roof, I can talk about law, tax, and financial planning. So what's any of that got to do with life insurance? Well, I'm going to build the subject as we talk and explain that if you don't understand law and tax, you actually can't give proper advice on life insurance. You end up giving people poor advice, or perhaps I should say inadequate advice based upon my experience. I'm going to show you some examples. First of all, why should you even be considering life insurance and beyond that, critical illness insurance, income protection, private medical insurance, anything with the word insurance that's based around the individual, as opposed to buildings insurance, contents insurance, car insurance, which everybody seems to focus on and trying to get a good deal, but they don't spend enough time talking about the driver and the driver of a car and the owner of a property, who really is fundamental to that. So being a property group, let's use property as an analogy. If you were building a house and putting up the walls of a house and capping it off with the roof, on its own, there's a big problem with that house because you failed to put in a key component, which is if you were building a house, the first thing you'd be putting in is a foundation. Because without a foundation, this is a wobbly structure. It could collapse. And so the foundation is what secures the property. Well, I describe myself as a financial architect. I help my clients to design their future financial homes. In your future financial home, your walls might represent your savings and investment program and capped off with your retirement program. All of that is flimsy if you don't have a foundation. And the foundation you need is to protect your income, either because you have an accident or illness and you need to create income, or to the extreme, you've passed away and your family needs to replace the income that you were bringing in to support them. So insurance is a foundation to everything else that you do. Property people, I find, generally speaking, not even generally, virtually everybody, focus on, as Akhil was talking about, trying to save 0.25% on an interest rate on the mortgage and are fighting over whether that's a deal breaker. fighting over the taxes they might have to pay or the running costs to an agent, all of those things. And yet they're not factoring into the acquisition of an investment property insurance to support the mortgage, especially if you've got an interest-only mortgage. The amount of people now that I'm talking to, and Alex, I'm sure you would agree, that have taken out interest-only loans, and they're now in their 60s and 70s or more, and they're struggling because they've got no way of paying off that mortgage. And if it's a husband and wife and one of them passes away, they're in trouble because it may be only one of them knew about the property portfolio and how to run it. So integrate the cost of insurance as part and parcel of the deal that you're doing. You know, sometimes I say to people, if your interest rate was 2.5%, but I could set up a self-cancelling loan for you at 3%, which meant that if you died or if you had a serious illness, the loan would be redeemed. Would that make sense? And they say, yeah, but nobody offers me that. So don't focus on the rate, focus on the whole situation. So I titled this up as to what could go wrong. Huge amounts could go wrong. Everybody thinks life insurance is, I was going to say dead simple. That's an unfortunate phrase when talking about life insurance. But everyone thinks it's just simple. It's all about price. And it's not. There are so many things that you need to know in order to get the right solution. Not the right product, the right solution. Price is only one factor. How do you buy it? I'm going to talk about the places where you could acquire your life insurance. Who do you buy it from? I'm going to drill down some detail about who are the right people to buy it from. And how do you know what's the best thing for you? Because there's so many different types of product policy on the marketplace. How do you even make an application? Note, I put the word valid application in my slides because it's very easy to make an application, but very easy to make an invalid application. If you make an invalid application, it may not pay out. Let's talk about that. So many people I come across, I'm going to spend quite a bit of time here talking about trusts. They don't know that the policy should be in trust. And even if they know that it should be in trust or they're told to put it in trust, they don't know why it's in trust. Even if they know why it's in trust, they don't know how to use the trust. Really important. I'm going to come back to that and explain a lot more. And then if it comes to a claim, how do you make a claim on life insurance? More importantly, how do you make a valid claim for critical illness insurance? You see, there's an art to making a claim. I've had clients who have been denied a claim for critical illness insurance, and yet when they've come to me and I've understood what the situation was fully, have got a complete decline through to a payout. Get it right, there's an art. And then I mentioned trusts earlier on, not just about putting it in trust, but using a trust. And for that, that's where my skill of knowing about law, tax, and financial planning, having the two businesses, means that I give joined up thinking to my clients. I don't just sell a policy, which is what most people do. I give you a complete solution. I'm going to spend a bit of time whizzing through what that actually means. So how could you buy your life insurance? Well, in the day of technology that we live in now, you can buy it online, you can buy it on the phone. Convenience doesn't mean good. It's just convenient. The fact that you could buy a policy at 3 o'clock in the morning when I'm asleep and Akil and other people are not going to talk to you doesn't mean it's a good thing, because you generally don't get advice. You generally end up with something that could be inferior. A lot of people, especially in the property world, will buy their life insurance from the mortgage broker because the mortgage broker has done a fact find on them. They know they've got a mortgage, usually a good time to put some insurance in place. Akil's not going to like me at this point, but I have to say, based upon my experience, mortgage brokers should concentrate on doing mortgages because it's a full-time job. By the way, I'm licensed to do mortgages, but I don't do them. I hate doing mortgages because, as Akil alluded to, it keeps changing, it keeps moving. And to me, that is a full-time job. But you find a lot of mortgage brokers also on the side almost do life insurance. My experience, and I'm very bold in what I say, my experience is that I've yet to see any mortgage broker, I'm sure Akil could be accepted here, but any mortgage broker that has set up a life insurance policy properly. I will explain what I mean by that. Or you could go and talk to a financial advisor who could then be a mortgage broker perhaps, but also give you holistic advice about investments and pensions and other aspects like your death in service. That's an interesting one, death in service with company. Never assume that your life insurance is built around your death in service. Especially in the last year, I have seen so many people that relied upon their death in service to protect the family. By the way, for those that aren't familiar, if you're employed with a company, some companies give you free life insurance as part of your benefits, usually 4 times salary, something like that. But last year, so many people have lost their jobs that they've lost their death in service. And a few people that I came across last year then said, I've lost that, I've become unemployed, can I replace it with my own policy? But they were ill and they were too old, it was too expensive, or they just couldn't get it because their health didn't allow them to. So treat death in service as a bonus on any life insurance package, not something you rely upon. You know, in my career, I've even come across a case where the employer didn't pay the premium, which nobody knew until a claim came through, and the insurance company then said, well, this policy is void because we haven't had a premium for it. So that's rare, of course, but death in service, quite often people aren't addressing it properly. So if you're going to go and talk to a financial advisor, what kind of financial advisors are there in the marketplace? Broadly speaking, they are either independent, which means that they work for you, not for a company or several companies. Means that they can source the products, the quotations from what's called whole of market. They're not limited to what they can offer you. The opposite to that is a restricted financial advisor. A restricted financial advisor, by definition of the word, is limited to a range of products, agencies with certain numbers of companies. A restricted advisor acts on behalf of their company they represent, not you. Some big names that are out there that are restricted that somehow try and avoid the subject about the fact that they're restricted. St. James Place, to pick on them, SJP as they're known, is a restricted advisor. If you talk to an SJP advisor, you need to ask, well, of any advisor, you should ask them, are you independent? Are you thinking about me? Or are you restricted and thinking about the company you represent? Quilter is another one. Openwork is another one. These are the big ones that are out there. Okay, so you found yourself an advisor. You recognize you need to make some decisions. How does your advisor get paid? Do they charge you a fee or do they rely upon getting a commission? I have both. For example, advisors who rely on making a commission because you bought a policy are therefore reliant upon you buying something. To me, that's not advice. Advice should be you pay for that advice. It's totally unbiased and independent, that lays out all the options available to you, and then you choose what to implement. So I charge a fee for giving advice. That advice may be, you don't need life assurance, because some people who are wealthy enough don't need it. But I'll tell you straight if it's the case. If you implement it, then in my firm, we get paid a commission, but I'm not biased on the product that I use as being one that's going to pay me the most, because you've paid for independent advice. Get that advice in writing. Get those comparisons done from an advisor as to what are your alternative choices. Let's move on to what are your alternative choices? What are the types of policy you could buy? This is now going to get scary, because if you know what all of these things are, I'll give you a job right now. So this is jargon, and I'm going to explain separately what all that jargon means. Do you know what a DTA is, an LTA, an ITA, an RTA, an RLP, a CTA, a FIB, a WOL, a PHI, a KIC, a PMI? Do you know what those are? I'm sure there's something in there that you've never heard about before, or that you may have heard of it but don't know how it actually works. So I'm very going to quickly get that confused look off your face and help you to understand some of this stuff. So The first one on there is something called a decreasing term assurance. I hate decreasing term assurances, but too many people have them. What are they? If you've got a repayment mortgage, quite often your mortgage broker will say to you, the cheapest way of buying the policy to protect your mortgage in case you die so that the family has the debt taken away is called a decreasing term assurance. It matches the shape of the mortgage and it goes down over time. That's probably the cheapest possible type of life assurance you could buy, but cheap doesn't necessarily mean good. You see, a level term assurance keeps the sum assured flat throughout life. So if I've got, say, a £200,000 mortgage, a decreasing term policy over, say, 25 years means in the last few months, if I died, it might only pay out £1,000 because that's what's left on the mortgage. A level term policy for 200,000 means that irrespective of the size of the mortgage, that is the sum paid out. So if the mortgage is only £1,000, the family keeps the difference of 199,000. Oops, sorry. The family keeps the difference. And an LTA doesn't cost that much more than a DTA. So I owned, in my entire 30 years, I've never sold a decreasing term assurance. I've always arranged level because it's far better value. And of course, if you move home in the future, then you've locked in a premium. And that's another point about premiums. They can either be fixed, guaranteed for life, or reviewable. Ask the question, because if you get a reviewable premium, it's cheap. But the reason it's cheap is because the insurance company's got the opportunity to increase that premium in the future if they feel like it. I call that insuring the insurance company, because invariably the premium could go up and you can't afford it. So pay a bit extra at the beginning and have it guaranteed, pay a bit extra and have it level, so that if you move home, you've already got the 200,000 of cover in place. Maybe you're older and you can't afford to buy more. Maybe your health won't let you buy anymore. An ITA is a version of an LTA, and it's inflation linked. It's increasing term assurance as opposed to decreasing. So it generally, both premium and sum assured would go up with inflation so that it maintains value. You're in control so that you have the ability to, sorry, my slides are playing up today. You have the ability to choose whether you want to take the increase or not. Most insurers will say, we'll offer it 3 years in a row, and if you decline it 3 years in a row, we're going to stick at the level you are. Okay. Do understand what you're buying, because not every policy operates in the same way. Some have a minimum level of increase, some have a maximum level of increase. Some increase the premium more than the index level of the sum assured. You really need to know what's happening. And if your advisor's not telling you, they're doing an inadequate job. RTA is a renewable term assurance. So one of the problems with a term assurance, generally speaking, is that it is fixed for the term. So you take a 25-year policy, you die 25 years and a day, tough. Your policy ran out the day before. You start falling ill 24 years and 11 months, and you know that you need this cover for longer, tough, because the policy is going to finish the next month. What a renewable term assurance allows you to do is renew the policy for a new term. So you might take out a 10-year policy, and at the end of 10 years, renew it for another 10 years. At the end of that period, renew it for another 10 years. That's a good option to have. The problem with it, however, is that when you renew it, it's priced at the age that you are at that time. So whereas you buy it now, and insurance is something you buy young because you lock in the rates for life or for the term, if you renew it, you'll be paying the premium for somebody who's 10 years older. There's no medical question, so it doesn't matter what's happened to you, but you will be paying more overall. A CTA is a convertible term assurance. It means that you have the option built into the policy to convert it to something called a whole of life policy. I'll talk about whole of life in a second, but it essentially means you can then say it's coming to an end, but I want it to carry on for the rest of my life. Very valuable option. I've exercised that option for clients numerous times because you don't have to answer any medical questions. So if you've got a policy and you started falling ill, then you can exercise the option to convert it, and it may be that you only pay the premium for another year and it pays out. Anyone quoting you should be quoting convertible term assurance alongside level term assurance. It costs a little bit more, but that option is extremely valuable. You will find most mortgage brokers don't quote a convertible term assurance, which is inadequate. What's a FIB? Family income benefit. So a term assurance, normally speaking, would pay a lump sum upon death. What a family income benefit does is pay the family an income for the rest of the remainder of the term. So if you took out a policy and said, if I died, I wanted £1,000 a month to go to my family, that's what the family would receive for the remainder of the term. So you took out a 25-year policy, 5 years in you died, it will then pay £1,000 a month for the next 20 years to the family. You can also choose for those to be indexed as well. Those are relatively good value. So obviously a lump sum can be used to produce income or pay off debt. But if you don't have any debts, but the family will need income, a FIB is a really good value way of creating that. The problem with any term assurance is it's a gamble. It's a gamble between you and the actuary. And invariably, the actuary will win because their records show that they're hardly going to pay out on these policies. But obviously, that's all insurance. When no one wants to claim, but it's covered if it is. A whole of life is a different animal completely. It gives you control, because as long as you keep paying the premiums, you are covered for the whole of your life, however short or long that may be. So the insurance company invariably is going to charge more because they're on risk for longer, but it is an incredible product if you actually understand it. And if you're taking out interest-only loans, then maybe you should be considering a whole of life so that should the worst happen, at any time, that debt can be repaid. Otherwise, what's your strategy for an interest-only loan? PHI stands for permanent health insurance. It's a fancy name for income protection. Probably the most valuable asset you've got is not your property portfolio. It's your ability to produce income. So a PHI or income protection policy says that if you fall ill or have an accident and it leaves you unable to work, whilst you're unable to work, which could be for the rest of your life or up to a certain age, say retirement, it will pay you a monthly income. The income is tax-free, and so there's limits on how much you can have. Everybody should be considering some form of income protection. It's essential. Alongside that, critical illness cover pays out if you die a little bit. So life assurance pays if you die. KIC, critical illness cover, pays if you die a little bit. Heart attack, cancer, stroke, multiple sclerosis, lots of horrible things that can happen, which don't necessarily kill you because people can recover from cancer and heart attacks, but a lump sum would be really helpful, either to pay off debt, adapt your home, adapt your car, pay for special care, or just say, look, I'm taking 6 months off because I've got a financial cushion. And PMI stands for private medical insurance. That's a bit of a luxury because in the UK, we're very fortunate to have the NHS. But if you're self-employed, sometimes you don't want to be on that waiting list. You want to go straight to the top and get treated the next day or the next week, not in 6 months' time. So private medical insurance allows you to jump the queue. It's not cheap, but for somebody self-employed, I'd class that as being essential part of your overall remuneration package. Another thing that people don't understand, and finally today, I just had a question from somebody saying, can I get a quote for a joint life policy? Until I explained the limitations. So if you take a policy out as husband and wife, or to any two people for that matter, but husband and wife is usual, you can choose a policy that's joint life first death. Means the first one to die, the policy pays out. The problem with that is the policy is finished. And my experience is that whenever I've paid out on a joint life policy, by the way, I've never set up a joint life policy. I think it's poor value, but people have them. And if I've dealt with a claim where one has paid out, the surviving spouse usually then says, so where's my insurance? And I say, tough, it's gone. You don't have it anymore. And so the problem with a joint life first death policy is the survivor's seen the benefit of it and now wants to know if they can have some of their own. Well, they may be too old. They may be too expensive and they may not have the medical background to be able to qualify. So joint life first death, you've got to know what you're buying. It's not great value. What's better, moving down a couple of bullets there, is 2 times single life. So 2 separate policies means that if one dies, the other one policy remains in place. And of course, God forbid, but if both died together, maybe in a car accident, the family gets a double payout. The one above that, a JLSD, is a joint life second death. That's what we use for inheritance tax planning. So it's a joint life policy, but it pays out when the second person passes, because that's when the taxman appears and wants to get paid. Any kind of life insurance you buy, you can choose to pay monthly or annually. If you pay an annual premium, usually you'll get about a 5 or 6% discount on the overall cost. So look at those numbers as well. Earlier on, I talked about fees or commissions. Talk to your financial advisor, which is what I offer, is that we don't take any commission, but we charge you a fee for setting it up instead. That is not cheap, but if you've got a lot of cash, it's cheaper for you overall to pay us up front and have a cheaper premium for the rest of the term. You'll make it up in terms of your savings. If an advisor is not giving you those options or talking about it, go and see somebody that does. I'm just going to move on from there. A couple of slides. So how do you make a valid application for life insurance? You know, anybody could make an application, but a valid application requires you to be honest. Full disclosure is required of your medical history, sometimes your family history, your occupation, your hazardous pursuits. You know, if you go parachuting and scuba diving, you're going to potentially, depending how much of that you do, pay more than somebody that doesn't. If you're a smoker, be warned, you are going to pay roughly double the premium of a non-smoker. For a lot of people, that's a good reason to give up. If you give up smoking, it's got to be at least 12 months before you qualify to be a non-smoker. Another tip, doing shisha is classed as smoking. So a lot of people sometimes get caught out. They say, no, I don't do this, but I smoke shisha. They are classed as a smoker. Being honest is important. If you don't disclose the questions that are being asked, you run the risk that the policy will not pay out. So the insurance company will, depending on the sum assured, write to your doctor for a report. For a higher sum assured, they may send you for a medical, which could be just a blood test and answer a few questions. Depending on a bigger sum assured, they may put you on a treadmill, take other kinds of samples from you. It all depends on the age and the sum assured that you're trying to take out. But honesty is key. When you read about policies not paying out, it's not the insurance company choosing not to pay out. It's usually because somebody, the word is non-disclosed. Don't fall into that trap. When you're taking out your policy, gather all your data, get the data ready of any medical issues you've had. When was it? What was the prognosis, the diagnosis, the treatment? Are you still on any kind of care or treatment? What is it? How much, if you're taking treatment, what is it? What's the medication that you're taking? Have all of that data ready, your doctor's details, the hospitals you may have attended, so that make the life for your financial advisor simple, please, by gathering this. Otherwise, we're going to go backwards and forwards and you know, it takes too long. When my clients do have to go for a medical, if you're my client, I'm going to hold your hand, meaning I will give you a tip sheet of things to prepare when you go for your medical. I learned that because I had one client who's ultra fit who failed his medical. Why? Because he ran a marathon on a Sunday, went for his medical on a Monday, and his enzymes were all over the place and he failed. And he was very angry about it, understandably. So we'll help you to make sure that you've got all the things you need to do. You know, don't go out on an alcohol binge the night before for going for a medical. Those little tips that will help you pass your medical. Different insurance companies will have different underwriting limits, meaning how much will they accept from you before they need further medical information. All insurance companies have different limits, again, depending on age as well. Sometimes it's easier to take a lower sum assured so that you don't have to go for a medical. Now, I don't advocate that because honesty is key, but have a discussion, frank discussion with your financial advisor, who may say to you, look, if you don't want the aggravation of going for a medical, keep your sum assured below 250,000 or 500,000, whatever those limits are. Because we're independent, quite often we'll shop around the market to see who's got the best underwriting limits to suit a particular individual. Now, not everybody is going to pay the premium we quote. And if the insurance company finds you've got some medical problems or medical issues, we call that a rated case. So let's say I quoted you a premium and it was, I'm making up a number, £100 a month premium, and the insurance company, because you're diabetic or you've got cholesterol problems or heart problems or whatever it might be, says, actually, we want £200 a month. Don't get angry. They're not picking on you. They're actually giving you acceptance on normal terms for someone in your condition. You see, your risk is greater, and therefore the fee, the cost to you is going to be more. So don't think of it that you're being singled out. You are paying the normal premium for somebody with those conditions. I'm sure you would expect that if somebody else had heart attacks, cancer, stroke, and you didn't, would it be unfair if they paid the same premium as you? Clearly not. Okay, so let's understand what a loaded case means. Just be happy you actually got covered, because the insurance company's got the right to decline you, and quite often that can happen. So being an independent advisor, if I am talking to you and I think you've got some medical issues that may cause a problem, we may submit applications to 5 or 6 companies and then play them off against each other to get the best possible terms. Give you some context. I've got clients that were declined by company A and accepted on normal terms by company B, just because we know how to deal with the underwriting of a policy. A good advisor that's been around a long time is actually going to do you so many favors. It's like a good mortgage broker. They'll be well connected. They'll know how to place a case that another broker may not be, or sometimes you may not be. Sometimes we've got to be a bit careful on what we say to a client. So if we see a client that is, let's say, rather large, and we know there may be a medical issue when he goes through his tests, we might say to him, you know, when the doctor looks at your chart of height and weight, don't be surprised if he says to you that you are slightly under height. It's much more polite than saying overweight. So on that chart, you may come out to be under height. And unless you can grow another foot, you're going to end up paying the premium for somebody who's under height. We had one client that was pretty borderline on his BMI ratios, and we encouraged him to actually go and have a diet and then come back to us. And he did, and we got his terms at normal terms, i.e. no loadings. So he now calls me not just his financial advisor, but his fitness advisor as well. So a good advisor is going to care about you, not just placing a policy. What a good advisor is also going to do is explain the need to put it in trust, put your policy in trust. Quite often they may talk to you about doing that and tell you to do it, but they don't force you to do it. I think that's negligence. I'm strong in what I say. I think that's negligence, because if you're looking after a client, you are looking after a client. I have a responsibility to my client to make sure that everything that needs to be done is done, not put the ball in their court to say when you get round to it. Why is it important to put a life insurance policy in trust? Number one, number of reasons. Number one, it doesn't form part of your estate for inheritance tax. Okay, if it's not in trust, it adds to your estate for inheritance tax, meaning the children could lose 40% on a payout. Number two, normally, if a life insurance is not in trust, the insurance company will wait for what's called the grant of probate, and that can take months for the payout to come through. Whereas if it's in trust, all they need to see is a death certificate, and within 10 days, that money could get paid out. So speed of claim. It also goes towards helping things like probate fees. And there's lots of talk about probate fees going up in the future, linked to the size of somebody's estate. If your policy is in trust, it's going to reduce the cost of probate. And if it's not, it's going to add to your estate and cost more. So just getting it in trust is beneficial, but that's not enough. In 100% of all the cases I've dealt with, the advisor that's put it in trust has not told the client how to use the trust. To me, that's negligence as well. That's like half a job. You know, if I told you to go and do something, but I didn't explain that in the event of that coming to fruition, i.e. a claim, how to then handle the trust, then the job is useless. So let me give you a real life example. Just recently, a guy phoned me. He said, sadly, my father passed away. My mum is ill. She's not got long left and she's very wealthy. I need to talk about inheritance tax planning. Okay, so tell me a bit about your dad. He had a £500,000 life insurance policy. Was it in trust? Yes. Okay, so the £500,000 didn't add to the estate. Good. So has it been paid out? Yes. So what happened? So he said, well, so where's the money now? And he said, it's in my mum's bank account. I said, how did that happen? And she said, because the insurance company called and said, we're ready to make the claim, pay it out. Who should we give it to? And she said, well, put it in my bank account. So that £500,000 moved as a claim into her account. What was the purpose of the trust? Because it's now no longer in trust. It now, when she dies, because she doesn't need this money, that £500,000 is going to lose 40%, which is £200,000. So the children will only see £300,000 of that policy. Why? Because the broker who set it up never told the family how to handle a claim. What should have happened when the insurance company called to say, we're ready to pay out, who should we pay it to? She should have said, I'm opening a trustee bank account, put it in there. That way, the money would have remained a trust asset, not her asset. Then let's say she says, well, that's no good. I need the money for whatever purpose, to pay off debt, go and buy handbags, whatever it might be. If she took it out the trust, then obviously then we've defeated the object of the trust. So here's where my skill comes in, and I call it an art of understanding law, tax, and financial planning, is that I would explain to somebody, you take an interest-free loan from the trust. That way you've got use of the money, but your estate owes the money back to the trust for the next generation, which means in that example, £500,000 would stay at £500,000 for the children. Do you understand how crazy that is? For one extra bit of work from the mortgage broker that set it up, it's cost that family £200,000. I think that's negligent. But if I wasn't there to tell them, they still wouldn't know this. So I'm very, very passionate that people need to make informed decisions and do not rely on somebody just being a financial advisor if they don't have expertise in trusts. It's not just about setting it up, it's doing it properly. In terms of a trust, you can get it directly from a life insurance company, that's free. However, be warned, most brokers will use the life insurance trust. What they don't tell you is that it's a draft document. The life insurance is not giving you advice, they're not warranting the document. In fact, at the front of all of those documents, so you never see it, they say, go and take legal advice that this is correct. Most life office documents are not good enough. I draft my own private trusts so that it is bespoke to the individual needs of that person. Okay, it's not free, you're going to have to pay for it, but the peace of mind for paying, say, £500 for a trust is immense compared to the risk of it not doing what you want. So, you know, for me, saying assign it to a trust sounds like a simple thing to do that most mortgage brokers, most financial advisors would do. It is not that simple. You've got to get it right and know what you're doing and why you're doing it. Then eventually, we hope it never happens, but it may turn into a claim. There is an art to making a claim. You know, if it's a life insurance claim, it's pretty straightforward. You just need a death certificate to prove that death occurred. Where claims management does come in as very powerful is if you've got a critical illness insurance. Because remember, it isn't about did you die, it's did you die a little bit? And the question really is, to make a claim on a critical illness policy, did you die enough? Did you meet the criteria of the technical definition? And again, I've taken clients that were declined by companies and turned into a positive claim because I knew how to handle that claim. So ask your broker, your advisor, how many claims have they handled? How many claims have they got through that weren't going to get through? What's their experience? When it comes to critical illness insurance, I can tell you, I said at the beginning, I speak at major conferences all around the world. I am the only person that has spoken 4 years in a row at something called the World Critical Illness Insurance Conference. Yes, there is such a boring thing. And the last time I spoke in Toronto, I actually took a claimant client with me to tell his story. So I'm very passionate about critical illness cover. It isn't just about selling a policy. I'm actually there at the other end to help you make the claim. Do not try and make the claim yourself. Unless it's clear cut, if it's borderline, you could get declined and not know why. I talked a lot about trusts, and we don't have time to go into the details of a trust, but I'm just going to explain the structure of a trust. So as we build upon this, I'm going to really hammer home some of these messages. So you as a settlor are the person who sets up a trust, and you put the policy in a trust. You appoint trustees. Those are the people that are going to manage the trust after your death. Clearly, during your lifetime, there's nothing in there. You appoint beneficiaries of a trust, which usually means your spouse, your children, and then I call it your remoter issue, your grandchildren and beyond. A life office trust will typically include spouses of your children. You don't want them as beneficiaries, which means that they could call on those funds. So a private trust will make sure that it's protected for what I call your bloodline. And then we have reserves, which most trusts don't have, which is what I call the Malaysian Airlines scenario. The whole family went off together, no one survived. Who's the reserves? I've never seen a life office trust talk about reserves. I've never seen a life office trust. I've never seen anybody's trust arranged by a broker or advisor that has a side letter called a memorandum of wishes that is a guidance document to the trustees. How can you have a trust where the trustees don't know what to do? So I'm not going to spend too long on talking about that, other than do this properly, get it right. Yeah, if you're only going to die once, apart from reincarnation, if you're only going to die once, die properly. Make sure your family's secure. Don't take a risk. Don't take a chance. Why is this important? You see, without planning, if a family got paid out £600,000 into their own pocket, upon their death, there's another 40% tax payable. And upon that person's death, there's another 40%, another 40% every generation. Eventually, that 600,000 on the million that you started from is whittled down to nothing. But if the 600,000 is paid out into a trust, it stays 600,000 down the generations, because how do the people get the money out of the trust is by taking an interest-free loan. They can use the money, go and spend it, but because it's a debt on their own estate, this is your beneficiaries, don't worry if I'm going too fast, I just want to illustrate a point. That reduces their estate, saves the next generation £240,000, the money goes back to the trust, and that's repeated by the next generation. Phenomenal planning. Not only does the 600,000 example stay 600,000, every generation saves nearly £250,000. Has your financial advisor told you that? Has your mortgage broker explained that? Because if not, why have you got a trust? And if you've got a policy that's not in trust, you are missing out a very valuable piece of your planning. Now, trusts are not perfect. There are lots of taxes to deal with on a trust, such as what I've put on screen. I'm not going to explain what those are, but they're all things that you can deal with good advice. Again, most financial advisors don't even know what some of these things are, like periodic charges. What are they? It's really important to know what they are, because if you know what they are, you can actually deal with them. I'm not going to explain at this time what a periodic charge is, except it's horrendous. It's a tax on a trust every 10 years, but it's avoidable as well if you know what to do. Example, let's say you've got a policy for 750,000 and it has paid out. And because you've listened to what I've said, it's gone to a trust. And because you've listened to what I've said, that 750,000 has now been borrowed out by a beneficiary. The trust has an asset of 750,000. It's got no cash, but it's got a debt owed to it. The periodic charge, I'm not going to go into the formula, is a tax on the asset of a trust. And if the asset is too big, the tax is horrendous. If you came to me with a single policy of 750,000 or wanting one, I would not give you a single policy. I would give you 3 policies of 250,000 each in their own separate trusts. I have never seen, and I'm exaggerating the word, I'm sorry, I'm not exaggerating the word never. In my 30 years, I've never seen anyone do this properly. Because first of all, they don't tell you how the trust works. And even if they did tell you that the trust works, they're introducing a periodic charge. In order to know why you would do this and how you would do this, you need to have the expertise of tax, law, and financial planning. This is phenomenal planning. So if anyone watching this has a policy of more than, let's say, £300,000, you need to call me urgently because you're introducing a problem for your family. If you've got £1 million, we need to break it down into separate policies. So for a lot of property people watching this, I want to talk about inheritance tax, but I don't like talking about inheritance tax because people switch off. Instead, I want to say you've got a debt on your estate. I'm not talking about mortgages. I'm talking about the tax being a debt on your estate, and the debt is repayable when you die. So even if you've got no mortgages, I can still say to you, you have a debt on your estate. Do you know the size of that debt? Means that 2 out of every 5 properties you own don't belong to you. 2 out of 5 is 40%. So for every 5 properties, 2 will be taken by the taxman to pay the inheritance tax on the 5. So on those 2 properties that will get sold to pay the tax, you're just the landlord for the taxman because of lack of planning. It gets worse, by the way, because let's say that was £1 million property that had to be sold to pay the taxman. What's the loss to the estate? You might say, well, if I had to say spend £1 million and sold a property, my loss is £1 million. No, it's not. It's a lot worse than that. What was that property doing the day before you died? It was giving you an income. So that property worth £1 million might be giving you 50k a year of rent. But now you've paid the million, sold the property to pay the tax. What's the loss to the estate? It's £1 million plus what the £1 million was giving you was £50,000 per annum. For how long? Forever. Forever. How big is that? So the government don't tell you this. They frame it as your liability is 40%. They don't tell you the loss to the estate is considerably more than that because you failed to plan. So if you've got your head around this, if you haven't, we need to talk. And if you have got your head around it and it scares you, that what is the point of creating wealth when you're going to lose not just the wealth, but the income from that wealth? We need to talk. We need to sort out your inheritance tax planning. In fact, we can then talk about how to use life assurance, not just to pay the tax, but to actually replace your wealth and free up your wealth. Because there's the biggest problem for property people. Their spendability is tied up in bricks and mortar. Let's say you've got 1.6 million of wealth. Reality, you're only going to leave £1 million after the taxman's taken his 40%, sorry, which is 600,000. The kids will get £1 million. What's a better way of replacing that debt is to create what I call a pre-funded trust. This pre-funded trust, the insurance company sets aside the 666 million in your name. You pay a servicing fee, an annual fee for this trust. And as long as you keep paying the servicing fee, when you die, not before, but when you die, the insurance company that runs a pre-funded trust will release that 0.66 million to pay off the taxman. That means instead of just £1 million going to your kids, they get 1.66, all of it. So there's no loss to the estate. Remember, if they had to pay that 666, they're also losing, call it 30 to 40,000 of income. Now they can keep all of the wealth, and you've just paid a small servicing fee every year. So in my world as a financial advisor, I talk about the third leg of planning, which most financial advisors only talk about the first two, which is they talk about wealth preservation and wealth enhancement, or wealth creation and wealth preservation is the two things. I talk about wealth enjoyment. Enjoy your money. And then I draw it all together and connect the law, tax, and financial planning, and I call it a legacy enhancer. Let's look at this. If you were going to leave 1.66, and we've already said the kids will only get £1 million, why don't we set up a pre-funded trust with £1 million in it? You pay a small servicing fee, which might be less than 1% of the 1.66, meaning you can now go and spend all of your money on yourself and not deprive the kids of the £1 million. Because that money is for you to enjoy. What was the point of it otherwise? And for a lot of people, they say, oh, I want to leave a legacy. If I spend it, well, what have I left? I can still leave a legacy of £1 million. And because it's in a trust, we've left it in an even better way because they can take a loan from it, which helps them in the future as well. In the meantime, go and enjoy your money, spend it. This is outrageous planning. I call it a paradigm shift of thinking, that you're allowed to enjoy your own money whilst the kids still get a legacy from you. Yeah, I call it a paradigm shift of thinking. So I'm not going to, this is too complicated. What's the next steps? I have probably never done a presentation so fast, forgive me, a lot to cover, and a lot's probably gone over your head. And again, forgive me for that, but it's opened your eyes, I believe, I hope, that a life insurance plan is a plan, not how cheap can I buy it. You've got to set it up properly. You've got to not fall into the traps. You need to know how trusts are going to work and do it properly. So speak to an expert. Don't talk to your mortgage broker because they're not an expert. Akil, I'm sorry to say that. I know you're part of this group, but reality, based upon my 30 years of experience, I have yet to meet any mortgage broker that knows enough about life insurance. They do it on the side. Most financial advisors don't know about law and tax when it comes to this space. Talk to somebody that knows all of it. If you want to talk to me, you don't have to, but you're welcome to. Here's my email address, which is my first name, Bhupinder, at anandassociates.com. Bhupinder, Bhupinder, at Anand, A-N-A-N-D, associates.com, or give me a call. I'm on 01895 457 440. I'm based in Uxbridge in West London, but I deal with clients all throughout the country. I'm on 01895 457 440. I hope you found that useful. I hope you found it informative. I hope it's opened up your eyes to potential opportunity for you to improve your own financial planning. I'm grateful to the Property Partnership for giving me the time to explain this stuff. And of course, to everybody, thank you and a very, very happy Diwali.
So nearly had some fireworks, didn't we? They were up in there between you and Akil. But anyway, it's like, you're both good friends. Right. So at least two takeaways for me is take this stuff seriously. And we're all, in my case, I'm definitely going to be height challenged when I go to my doctor for my medical. I'm not
Are you under height, Bill?
Okay.
Are you under height? I'm
definitely under height. I need to get a stretching. That is a great way of putting it. I'll remember that one. I'm definitely under height. So I think a lot of people will be under height by the time we get to January after Diwali.
Well, after Diwali tonight and all the sweets, yeah. Don't go for a medical tomorrow.
And Christmas, so definitely don't go to a medical tomorrow. And
yeah, your blood sugars will be all over the place.
Yeah, and watch out for Christmas as well. That's another.
I need to add that to my medical tip sheet.
What's that?
Don't go for a medical the day after Diwali.
Diwali or Christmas or a weekend, actually. So, it reminds me, I was sitting in a phone shop having a conversation. I said, it's a bit quiet. He said, no, Mondays are busy days because everybody loses their phone over the weekend. And sorry, off tangent. No, look, as I said, put down your colouring pencils. Where's my pen? Get out your pen and take some serious notes. There's some serious stuff. There's serious issues. Thank you for that. And like I said, we have some great professionals on this show. Bhupinder, thank you for your time. I'm going to ask you one question, actually.
Yeah, before you do that, I'm just going to apologise to Akil because I had to go at mortgage brokers quite a lot, but that's not personal.
No, it's Bhupinder. No. There's no issue whatsoever, and I've learned so much from a short of an hour of speaking there, and it's imperative. I think if anybody wants to take anything away from what Bhupinder said is, take up the relevant advice, but from a professional. And Bhupinder's obviously clearly an experienced individual, and if you're I always say stay in your lanes. I'm a mortgage broker and that's what we're fixated on, and it goes back to what I did touch on earlier. You've got to surround yourself with a good power team that are experienced and know their stuff. So Bhupinder clearly knows his stuff. I think people should reach out, even if they've got trusts and things in place. I think it's good, and Bhupinder might want to back me up, is to have things reviewed annually. And I always stress to my clients, you touched on it, everyone wants the cheapest car insurance and buildings insurance, but you know, life insurance, critical illness insurance, family protection, you know, all those PMIs that everyone talks about, Bhupinder talked about. There's so many variances out there, but please get them reviewed. Even if you think you've got everything up straight, you have changed your circumstances, you have extra children, you know, you might have a third child, but at the time of doing your trust and everything, you only had 2 children. So I think it's key that you review your policies and give Bhupinder a call. And if you've got a mortgage coming up, then you should give us a call. So I'll leave it there, but happy Diwali and thank you so much for your time.
Can I just add to that, Dil, what Akhil just said, because it crossed my mind, I forgot to say it earlier on. Part of that review process is to look at your existing policy and see if it's got an option within it to increase the cover without any medical questions. These are called guaranteed insurability options, and a lot of people don't even know they have it. And I've used that option many times where somebody's not capable of buying life insurance because of health issues, and instantly we can increase their cover. They don't answer any questions, and they've bought something that's gold dust because they can't buy it elsewhere. So, Akhil, you're 100% right. That won't come out unless somebody's knowledgeable enough to say, I'm not going to look at the cover and the premium. I want to see the policy document. I want to look for the small print that the clients don't even know exists.
Yeah, and let's hope that the insurance underwriters aren't listening to this. So we might have given away some piece of magic. Now, Bhupinder, next time you come on, what are you going to discuss? What are you going to talk about?
That's a really good question. I might talk about mortgages.
Great. Next time we'll put you first. And then
by the way, I know nothing about mortgages. So I'll get some coaching from Akhil first.
No. Fair's fair. If you're talking about mortgages, we're going to put you first and then let him have a go at you. But no.
We'll do roles reversal next week, perhaps.
Exactly. Yeah, not next week. We've got a friend of yours on Akhil, actually. Well, friend of both of ours, actually. And you. No, I'll have to tell you who it is. It's we've got 𝗟𝗚𝗙𝗘 𝗜𝗡𝗙.
Oh yes, the accountant. Yes,
the accountant. So there we go. And Bhupinder, I can't get you on next week because there might be too many fireworks.
I think people will get fed up with my voice otherwise. But
there might be too many fireworks if we keep every week. But no, look.
Yeah, because I'm, as you know, I'm very vocal and I say it the way I see it. So
mucking around aside, thank you for that information. And I was getting through all your TA chart and I was going to say, it's all the TARs, thank you very much. But you changed it at the end. So I can't get away with that joke. But I'll definitely take away the height challenge. I think I'm going to get myself a stretching machine so I'm not a height challenge. But look, I think, thank you, gentlemen. It's been an interesting conversation. Great to have you both on. Akhil, we'll see you next week. Bhupinder, we'll see you soon. Let me know what you're going to talk about next week and we can get you a sparring partner for the next shows.
We should.
Great.
Thank you for the opportunity and I just hope people have benefited from both.
Yeah. No,
comments.
Joking aside and mucking around aside, there's some really interesting stuff, apart from the height and the weight stuff, that we don't actually think about because we're not in the field. And it happens in all fields. So thank you for that. Great share. We'll see everybody next Thursday, 5 o'clock. And as the nights darken, enjoy your Diwali, and we'll look forward to seeing everybody next week. Thank you very much, folks.
Again.